So, have you ever wondered how the modern economy just keeps churning out mortgages and commercial loans, even when it feels like everyday people are pulling their cash out of the bank to chase higher returns in the stock market? It's honestly this massive mystery of how modern banking actually functions behind the scenes. Welcome to This Explainer. Today, we're going to completely deconstruct the architecture of credit generation and solve one of the most fascinating macroeconomic paradoxes out there right now.
We've got a lot to cover, so here's our roadmap. 1. The Great Banking Paradox. 2. The Fractional Reserve Myth. 3. The Wholesale Funding Lifeline. 4. The Securitization Engine. And finally, number 5. What happens when the system breaks?
Right, let's jump straight into section 1, the Great Banking Paradox. How exactly do banks lend without your savings?
Let's start with a really fundamental question. Because of the incredibly low and, sometimes even negative interest rates on savings accounts we've seen over the years, retail and corporate customers have been heavily incentivized to just migrate their capital straight out of the banking system. They take their wealth and they dump it into equities, mutual funds, alternative assets, anything just to find a decent return. So here's the paradox. If the banking sector is experiencing this structural deposit flight, where exactly is the loan money coming from? How do commercial banks continue to afford originating these massive commercial and residential loans?
Just to wrap your head around the sheer, staggering scale of this mystery, look at this number, $13.1 trillion. That's the size of the U.S. mortgage market alone. Trillion with a T. It is structurally impossible to fund that massive footprint just using traditional commercial bank balance sheets if retail deposits are constantly walking out the door. So, what's the secret? Well, to solve this mystery, we first have to realize that almost everything we learned in Econ 101 is, frankly, completely wrong. Which brings us to Section 2, the Fractional Reserve Myth. Let's dismantle some textbook economics.
Okay, it's time to snap out of our preconceived notions here. The old textbook theory, the fractional reserve model, says banks have to gather your deposits first, hold a fraction in reserve, and then lend out the rest. It implies that banks are strictly constrained by public savings. But contrast that with modern reality, a concept called endogenous money. Leading global central banks have formally refuted that old model. Banks absolutely do not need your savings to make a loan.
Let's define this clearly, because it's the absolute foundational principle of modern banking. Endogenous money simply means loans create deposits. When a bank extends a 30-year mortgage, they aren't going into a vault and handing over a pre-existing pool of saver deposits. No, they literally type the money into existence through dual entry accounting. The very second you sign that loan agreement, the bank records the loan as an asset and simultaneously creates a brand new deposit in your checking account as a liability. They are creating broad money ex nihilo, out of thin air, meeting credit demand without needing a prerequisite pool of savings.
And if you want to permanently dismantle that old multiplier myth, just look at what happened in March 2020. The Federal Reserve officially dropped statutory reserve requirements on net transaction accounts down to exactly 0%. Zero. That mathematically killed the old fractional reserve formula for good and definitively proved that bank lending capacity just isn't mechanically constrained by a fractional reserve of retail deposits.
Okay, let's peel back the next layer and see how this builds. Section 3, the Wholesale Funding Lifeline. How they survive the daily cash drain.
So if banks can just create money out of thin air, how do they survive the daily cash drain when customers take that newly created money and move it to another bank? This brings us to a really vital distinction. Sure, banks can create broad money internally when they lend to you, but say you take that money, you buy a house, and the seller deposits that check in a completely different bank. Well, the originating bank has to settle that transaction, and that creates a massive constraint. They can't just use the broad money they just manufactured. They desperately need actual narrow money, meaning central bank reserves, to manage that outflow.
So the crucial point here is that they have to aggressively source external short-term liquidity, and they do this through a huge wholesale funding complex that's basically built on three main pillars. First, the federal funds market, which interestingly enough is actually dominated by non-banks now. Second, the repo market. And get this, 64% of cleared repo volume trades by 8:30 a.m. every single morning. Banks are literally scrambling for this cash bright and early just to avoid daylight overdraft charges at the Fed. And third, you have Federal Home Loan Bank, or FHLB, advances.
The FHLB is incredibly important to this whole operation. It's a government-sponsored enterprise that raises funds globally and then lends them to commercial banks. And because the FHLB carries this implied government guarantee, they can borrow super cheaply. They're passing an estimated $6.9 billion structural subsidy to commercial banks in 2024 alone. This low-cost wholesale advance acts like a massive lifeline, keeping banks highly liquid despite all that deposit flight we talked about earlier.
But wait, even if they have their daily liquidity sorted out, a bank's balance sheet is still fundamentally finite, right? They have very strict regulatory capital constraints. So how do they not just run out of room? Let's get into Section 4, the securitization engine, the infinite recycling loop.
This is the part where the bank stops acting like a traditional vault and starts acting way more like a factory. Securitization is the real magic trick here. It's a structural financial innovation that basically takes all those illiquid 30-year mortgages and 5-year auto loans, bundles them all together, and transforms them into highly liquid, tradable securities. It allows the bank to rapidly offload credit risk and free up balance sheet space so they can immediately recycle their capital.
It creates this brilliant originate and distribute assembly line. Step 1 is origination, where they extend the credit. Step 2 is isolation, transferring those pooled assets over to a legally distinct special purpose entity that just protects investors in case the bank actually goes bankrupt. Step 3 is structuring them into specific risk tranches. And finally, Step 4 is distribution, selling them right out into the secondary capital markets. By doing this, banks are effectively getting reimbursed for the mortgages they make within weeks or sometimes even days.
To understand just how standard this practice is today, at least 59% of all originated mortgages are quickly sold off to third parties, heavily supported by government-sponsored entities like Fannie Mae and Freddie Mac. This continuous, rapid-fire process frees up their capital, which lets lenders execute almost infinite rounds of lending within a single fiscal year.
And right here is the beautiful resolution to our great banking paradox. Remember those retail customers who took their deposits out of the bank to put them into mutual funds or pension funds, chasing better returns? Well, those exact same mutual and pension funds turn around and use that exact same capital to purchase the securitized loan assets from the banks. It's wild. The capital is flawlessly recycled in this infinite loop right back to where it started. The system literally fuels itself.
But as precision-engineered and flawless as this infinite loop might seem, it definitely isn't invincible. Let's explore Section 5, when the system breaks. We'll look at the 2023 banking crisis and the ultimate backstops.
Because we saw exactly what happens when this highly leveraged machine violently breaks down back in March 2023. Rapid Fed interest rate hikes had absolutely crushed the market value of banks' supposedly safe fixed-income bonds. And at the exact same time, panic depositors triggered an unprecedented bank run. The banks were totally stuck. They couldn't sell their bonds to get that crucial settlement cash without realizing catastrophic insolvency-inducing losses. The whole wholesale market essentially froze.
To stop a total systemic collapse, the Federal Reserve had to step in with an emergency facility called the Bank Term Funding Program, or BTFP. And when you compare this to a traditional discount window, there is one shocking difference that jumps out: collateral valuation. The Fed, incredibly, decided to lend cash against the original full par value of the collateral. They completely ignored the massive, real-world depreciation, like 20% average market value losses on those pledged securities. This gave banks the vital cash they needed to pay fleeing depositors without forcing them to realize those devastating balance sheet losses. But this unprecedented intervention exposed some pretty severe structural flaws. Because the BTFP loan rate was dynamically tied to a one-year swap rate, by late 2023, the borrowing rate fell entirely below the interest on reserve balances rate, which is the rate the Fed pays banks just to hold their cash. This generous intervention accidentally created a massive risk-free arbitrage loophole. Banks quickly realized they could just borrow billions on the cheap from the Fed and then deposit it right back at the Fed for a guaranteed risk-free profit. Zero downside. Peak borrowing surged to over $165 billion before the Fed finally had to forcefully close that loophole.
And you know, this emergency largesse carried immense systemic costs. Because the Fed lent at par value instead of market value, those loans were severely under-collateralized. The risk was basically transferred directly to the public sector. We saw this materialize directly when First Republic Bank defaulted. They held a massive BTFP loan backed by underwater collateral. The FDIC had to step in, and their deposit insurance fund was forced to absorb a staggering $3 billion collateral deficit. The cost of all this central bank generosity was shifted straight back onto the broader system.
So wrapping up this explainer, I think it becomes pretty clear that modern banking operates way less as a passive intermediary of stored household wealth and much more as an active, highly leveraged engine of credit creation. Banks do not wait for your savings. By continually securitizing assets to recycle capital back from the financial markets, by plugging their daily cash gaps with wholesale advances, and by heavily relying on central bank interventions during acute stress, we can see that the system is fully capable of financing our economy entirely independent of the retail saver.
But I want to leave you with this final thought. We've seen just how brilliant this machine is at generating continuous credit. But when the wheels inevitably fall off, and the ultimate backstop to this magical banking machinery becomes the public sector, if the taxpayer is the one absorbing the risk of these under-collateralized bailouts, who is really bearing the cost of this illusion? Who is truly underwriting our modern economy? Think about that the next time you log in to check your bank account. Thanks for joining me on this deep dive, and as always, keep questioning the systems around you.